last year, we outlined that China could surprise as one of the top performing markets for 2024. Now, it didn't look like that was going to be the case in the first half of the year, but China has surged higher in the second half following the central government's announcement of comprehensive stimulus measures in September. Despite the threat of higher tariffs under a new Trump administration, China is on track to be one of the top performing markets globally this year. So the question on everyone's mind is, now what? What about 2025? In our mind, there's still a very high likelihood, far greater than the market currently suggests through still depressed valuations, that China continues to be one of the top performing markets globally in 2025 as well. Let me try to quickly frame why. The current setup remains very attractive, particularly on a relative basis versus the rest of the world, and especially given that you now have a stimulus backstop from the central government across all fronts, from liquidity measures to monetary easing and fiscal stimulus. So just like the old adage, don't fight the Fed, the odds are stacked against a fight versus China's stimulus arsenal. If you look at valuations alone, China is the cheapest major market globally by far, both on an absolute and relative basis, despite the recent outperformance. While the macroeconomic backdrop has been challenging over the past 3 years, does the market really deserve to be less than half the price of the United States or 1/3 the valuation of India? China's economy is closer to a cyclical trough, while the US and India are likely near cyclical peaks. Even against markets with far weaker earnings growth like Europe or Japan, China trades at more than a 50% discount. Now, this is the market as a whole, and if we consider specific segments like the consumer or technology, the valuation discrepancy is even more stark versus global peers. It's important to understand that despite all the recent doom and gloom, the Chinese economy and consumer are still growing at a steady 4 to 5% this year. While China's real estate market has been a big driver of this underperformance and negative sentiment, the economic baton is now intentionally being passed from the real estate sector to advanced industrial manufacturing and consumption, as this chart shows. On the industrial front, China's strength is manifesting itself in leadership positions across clean energy, materials processing, automotive, and semiconductors. Some would argue that China is just getting started on many of these fronts. On the consumer side, the Chinese government has outlined at least $1 trillion in stimulus for local government debt swaps and property buybacks that should at the very least stabilize the real estate sector and elevate consumer sentiment from depressed levels today. On the company side, if you look at this chart, Chinese corporates are flush with cash. Excluding financials, they hold an estimated $2.3 trillion in cash on their balance sheets, equivalent to around 27% of their total market cap, which is amongst the highest in the world. They're now using this massive hoard to increase shareholder returns in the form of buybacks and dividends, as we've seen firsthand across our own equity holdings. The government is also actively encouraging buybacks, with the PBOC announcing a brand new re-lending facility that can extend $100 billion or more than $100 billion at an interest rate of 2.25%, intended to encourage listed companies to borrow and buy back stock. Most companies don't even need to borrow given their cash hoards, but if their businesses can yield more than this 2.25% interest and their growth prospects are intact, then it becomes very accretive to borrow and buy back stock, which many companies have already started doing. All these factors have led to total shareholder returns exceeding total financing proceeds in China for the first time ever this year. And as long as valuations stay near current levels, this is likely to continue to be the case next year as well. finally, one only needs to zoom out on China and look beyond the immediate noise to understand the extent of the value proposition. The Hang Seng index is around the 20,000 level today, which is the same level it was in 2006, almost 20 years ago. China's GDP was close to $3 trillion back then. Today, it's almost 18 trillion. So the economy is 6 times bigger, but the market is just 10% higher, which shows you how negative sentiment has become. At the same time, China is now an industrial and technology powerhouse, which is different to even 5 years ago. They're fast becoming the most prolific automaker with more than 60% market share of electric vehicles and more than 80% share of electric batteries. If you believe that the energy of the future will be mostly manufactured like solar, wind, or nuclear versus being drilled or mined in the past, then China is positioned to be the world's largest manufacturer of clean energy products for a while to come. They're replicating this same industrial playbook in aerospace and semiconductors as well, which the West is now attempting to curtail. So despite the possibility of higher tariffs and more geopolitical wrangling with the US, it's unlikely that such a powerhouse can remain at 8 times earnings for too much longer. Given the current stimulus impulse with the government, we believe that 2025 could be another strong year of outperformance for China, particularly given how expensive the rest of the world is in comparison. Thank you. And with that, I'll hand it back to you, Linda.
Thanks, Ishreth. I guess the question on everyone's minds is that, of course, in the face of a Trump presidency, there's a lot of talk of obviously rises in tariffs and an escalation in the US-China trade war. What if the Chinese equity valuations, for those reasons, just simply stay depressed?
Thanks, Linda. So I think it's important to go back to earnings, right? Chinese stocks have already been through a historic derating over the past 3 years. And maybe certain segments of the economy, like say real estate and construction, may remain depressed because earnings won't grow. But other segments like high tech and consumer should see growth and earnings return with increased spending within those specific sectors, which is exactly what the central government is trying to stimulate. Also, it depends on what happens to earnings with the rest of the world. US and Indian earnings, for example, are very elevated. And if Trump enforces his America First protectionist policies to the extent he's outlined, it could be highly inflationary and lead to massive supply chain bottlenecks for American businesses. This, in turn, could be bad for consumer sentiment and corporate America as well in the short term. There's also the possibility of a recession or an inflation-led sell-off like in 2022. So it's more a question of relative performance, in my view. Just given the current starting point, there's a lot more margin of safety embedded in the Chinese consumer and technology stocks we own than the American ones.
Okay, Ishreth, what about the fact that something we've debated around the table in our investment team is the excessive competition that we're seeing in China? Does that not affect the ability of Chinese companies to return, to generate decent returns on their capital in the sense that there's a race to lower prices and that, of course, causes a massive erosion of margins?
That's a great question, Linda, and something we think about a lot. First of all, I think it's important where we choose to participate. We are not investing in heavily capital intensive, new cutting edge sectors or commodities where the steady state economics are very unclear to us. The auto industry is notorious for this. Even when the automobile was first invented, there were hundreds of brands that emerged, with more than 95% of them going bust over time. So that type of radical and uncertain change is definitely not something that would be attractive to us. What we do tend to invest in are businesses that already have proven economics and moats, which are evident in their returns on invested capital and their margins, particularly going forward. Often these companies have already emerged as clear winners from competition. They own the customer and have advantages like network effects, brand, or scale, where they're the lowest cost producer, which further reinforces their earnings flywheel. Now, that's not to say that those types of businesses also don't have competition from time to time, like we see in the Chinese e-commerce space, but it's a bet on management and their ability to weather the storm as well. So, for example, companies like Walmart and Costco have continued to thrive despite Amazon's growth and fierce competition. It also depends on your valuation starting point and what's being priced in and the variant perception we have on future earnings or value. So just for an example, we built most of our Chinese e-commerce position once competition had already ramped up, and when it became evident that market share was starting to stabilize and valuations approached levels that made no sense versus our earnings expectations. Alibaba, for example, was trading at less than 3 times free cash flow, excluding investments, despite their now stable and still dominant positions in e-commerce, payments, cloud computing, and AI in China. Now, when we do go into competitive industries, not just in China, but across the rest of the world as well, it tends to be at the very bottom of a cycle where we have a clear variant perception on the winner that would emerge from all the turmoil. The market is usually very pessimistic when an entire industry is losing money, which is clearly not sustainable and leads to often like supply consolidation and fantastic returns for the winner that emerges from that consolidation.